thank you guys so much for attending this session today. In our webinar series of Cash Flow Champs, is our intention to bring you good content on a weekly basis to develop good business relationships with you and just to be a resource for you in the multifamily real estate space. Today, we'll be covering the topic Capital Stack Explained for multifamily syndication. So in this webinar, we will cover what is a capital stack, priority positions in the capital stack, risk positions in the capital stack. We'll also talk about single tier and dual tier equity structures and more. So let me just take a quick minute to introduce myself, and for those who don't know me, and to just tell you about some resources that can be helpful to you. I am Paul Sr. I'm one of the managing partners at Cash Flow Champs. Live in Maryland, right outside Washington, D.C. with my family. And just to get some more information on myself and the rest of my team at Cash Flow Champs, you can simply go to our website, cashflowchamps.com. And if you hover over the About button, then you can just click on that, and then you can read some more information about each and every one of us, what we've been doing in the multifamily real estate space. I'm co-host of the Cash Flow Champs Real Estate Podcast with my partner, Prashant Kumar. And our team right now have a portfolio for about $146 million asset under management, a little over 1,600 doors. And good news here too is that we're going to add to that. We currently have an asset on the contract in the Atlanta MSA, a $32.3 million asset, a little over 200 doors. And we welcome you to invest with that. That's a live offering going on right now. We can share some more information about that with you. Very, very good returns on that. We did a webinar on it last night, and people are excited about it, so we can share that with you. In terms of some free resources that we have for you, one of our managing partner, Charles Seaman, does an underwriting session every Saturday at 4 p.m. Eastern Standard Time. Then encourage you to go there for that. Go there on Saturdays at 4 p.m. for those underwriting session. If you want to improve your underwriting or to evaluate a deal, that'd be a great thing. You can simply scan the QR code on your screen here, and you'll get some more information on that. And I'm pretty sure that you'll find that valuable. He goes through the T12, the rent roll, and the OM, and just to show you how we underwrite deals. And he's very kind with his time. We also have the Aristocrat Coaching Program. That is a paid program that you can work with the Cash Flow Champs team. We have a few students right now, and we're growing that. And so you're welcome to join us. We are promising and delivering on students closing their first deal with us if they haven't closed a deal before, or if they just simply want to grow their portfolio, then we're here to teach them it as well. The Cash Flow Champs team is very experienced. I've gone through many full cycle deals, and just want to share the knowledge there. And maybe one of the last things is just the summit. We have an annual summit. It's going to be in November of this year, November 17th, 18th, and 19th. You can go to cfcsummit.com and sign up there. Would love to have you. Now, if you have any questions as we go through, feel free to put those in the chat. We'll get to those throughout the session or also at the end of the session. And we want to make sure that all your questions are answered to the best of our ability before you leave here today. Just a disclaimer that I'm not an attorney, financial advisor, tax advisor, or an accountant. The purpose of the webinar is for information purposes only. So you want to seek professional advice from the appropriate personnel as you consider the information that we are sharing here. So we said earlier what we're going to cover today. So let's just engage the topic of Capital Stack Explained for multifamily syndication. Now, the picture on your screen is just an example of a capital stack. And by definition, the capital stack in real estate is simply the organization of the debt and the equity used to finance the real estate transaction. So what are the components of the capital stack structure? Well, the more complex capital stack will have 4 components. You'll have the senior debt, you'll have the mezzanine debt, you have the preferred equity, and the common equity. So typically you start the stack at the bottom with the senior debt and you build from there, right? So it's kind of like playing Legos, right? You start from bottom and you build up. So the senior debt is your main lender. You can consider your main lender as your biggest partner in the deal. So typically, you get your senior debt from banks or bridge lenders or agency lenders, like Fannie Mae or Freddie Mac. Well, technically, Fannie Mae and Freddie Mac are not technical lenders. Of course, they approve and work with licensed lenders like Arbor and many other licensed lenders out there. But you on top of the senior debt, you want to stack your mezzanine debt. So the mezz debt tends to serve as a supplemental loan in many cases. So the mezz debt is not very common in syndication structures, but you will see it occasionally. And next in the capital stack is your preferred equity. And of course, you finish it off with your common equity. So if you look at the left of the capital stack, you will see an arrow and it's pointing up. And this indicates that the level of risk increases in the capital stack from the bottom to the top. So the higher you are in the capital stack, the higher the risk. And conversely, the lower you are in the capital stack, the lower the risk of the investment, right? So consequently, the senior debt would be considered to be in the lowest risk position in the capital stack. So an investor's return on investment is directly proportional to the risk. So the higher the risk, the higher the return on the investment. So the senior debt is in a position of lowest risk, so it gets the lowest interest rate, which equates to the lowest return. So as you go up the capital stack from the senior debt to the common equity, your cost of capital tend to increase. So the return to those investors will increase as well. So for example, if your senior debt is commanding a 5% interest on its capital, then you would expect your investors at the mezzanine debt level would achieve a minimum of that 5%. So it'd be 5% plus for those, right? So on your right-hand side, talking about priority, the arrow on the right of the capital stack is more referencing the level of priority of the different components we're talking about. So the arrow is pointing down, so as you move from the common equity position at the top to the senior debt position, then your level of priority increases. So the senior debt has the highest priority in the capital stack, and the common equity has the lowest priority. So the lower you are in the capital stack, you will be paid your return on investment first. So the senior debt will always be paid first. That is why it has the highest priority in the stack. So just as an example, if you were to buy a property like 100+ unit apartment, it is typically encumbered with a debt. If there's no interest only period, then you will be paying the full debt service throughout the whole period, right? So when the property sells, the senior debt holder will be paid first. So the full loan balance and any interest will be paid in full before any other debt gets paid. So if there is a mezzanine debt, it would be next in line. And the mezzanine debt, like I said, normally come in the form of a supplemental loan or a secondary financing. So that would be next in line. And after the debts are paid off, then the equity positions start receiving payment, right? Which would be your preferred equity, which would be next after the mezzanine debt. So, and of course, you finish off with your common equity. So preferred equity, let's talk about that just for a second. What is preferred equity, right? So the preferred equity is really a hybrid between debt and equity. So it has some characteristics of debt and it has some characteristics of equity. So like debt, preferred equity, it has a priority over the common equity, right? And it also earns a fixed rate of return. The preferred equity also have default remedies and control rights. So it has all those as a part of the debt portion of preferred equity. On the equity side, like common equity, it is more expensive. It's a more expensive form of capital and is also subordinate to your senior debt. So when you structure preferred equity in the capital stack, it's typically done so that a portion of the interest or the payment that is made on a monthly basis. It's kind of similar to your regular debt service. And the rest of it is accrued and paid off when there's a capital event, meaning like a sale or a refinance of the property. So, for example, if a sponsor borrower pref equity, say at 12% simple interest, then the payment can be structured so that you pay 6% on a monthly basis out of the cash flow, and the other 6% is accrued until sale, right? So you can structure it anyway. You can split it 9, 9, and 3, whatever. So it just depends on the cash flow that's coming off the asset and what you can manage. So in terms of arrangement, that can be a little bit flexible, right? With the mezz debt, like the pref equity, also have some type of debt and also have some type of equity characteristics to it, right? So again, the mezz debt loans are subordinate to the senior debt, and it has a higher priority in the capital stack, as you can see, compared to the pref equity and the common equity. So the key difference between the mezz debt and the pref equity is just really in the legal structure of both. So the pref equity investors, they have direct ownership of the borrowing entity for the real estate, right? So when you buy an apartment complex, like a 100-unit apartment complex, you normally get to form an LLC for that. And in that property LLC, and inside that LLC, you place the property in there. So your pref equity investors would have direct ownership in that borrowing entity, right? The mezz debt lenders, on the other hand, they tend to hold a pledge of the equity in the property, and they hold it, that's their collateral, right? So an equity pledge is more an agreement between the borrower and the lender, where if the borrower defaults in the mezz debt scenario, if the borrower defaults, then the lender can foreclose on the LLC interest that owns the property instead of foreclosing on the property itself. And that's big, because by foreclosing just on the interest and not the property, then they can circumvent the judicial foreclosure process, because the judicial foreclosure process going to the court systems normally take a long time, right? So so the structures, the legal structures between the pref equity and the mezz debt are different in that way. Some similarities between the two is that both the pref equity and the mezz debt, again, provide supplemental financing, and both of them are subordinate to the senior debt. So both of them also have priority over the common equity, and you can see that the common equity is in the lowest priority position, like we mentioned before. So both the pref equity and the mezz debt has priority over it. Another similarities between the mezz and the pref is that both has default remedies in case the borrower cannot really, comply with the loan terms. Then the lenders have an option in terms of, what to do, either foreclosing or on the interest itself, or foreclosed on the property itself. So normally the sources of equity, you got pref equity groups out there that write big checks, and they come in and they can help you with your capital raise. You have mezz debt out there as well. You can go with their private lenders who will provide funding for mezz debt. You have some local banks. I know BB&T does that in terms of your mezz debt. You also have local investors, and you also have debt brokers out there that can shop for these type of debt for you when you're looking to use them in your multifamily syndications. Let me touch a little bit on the single tier equity structure, right? This is really the most common structure used in apartment syndication, where you have your senior debt, and your senior debt here typically accounts for about 55 to say 75% loan to value, right? And if you notice, there is no mezz debt here, and there's no pref equity in this structure. So what you have here typically is your senior debt and you have your common equity. So in this market, you know, your senior debt, you're probably getting about, if you go agency anyway, probably get 55 to 60% LTV just because of the lending conditions right now. But a year or two ago, you could get 75% or so LTV from most of these lenders out there. So there's a range there, and it just depends on, you know, what market you're in. So by single tier equity, it simply means that only one class of shares is available for the investors to invest in. And as we can see here, that would be the common equity shares, right? So you can have more than one class of common equity investors. So here is showing class A and class B investors, right? So the common equity class B in this case are your general partners, and your common equity class A in this case is your LP partners. You can also go in this class A and divide it up even more, but we chose not to do that because in that class A you can get in there and you can have just different classes based on a different pref. So you could get in there, you could put a 7% pref, you could put it at 8% pref, you could put a 10% pref, and all of those go into the class A. And but normally sponsors do that in the sense of enticing people to put more in the investment for their raises, right? So for example, if you have a 7% pref in that class A common equity portion, you can say folks got to go invest between $100,000 and say $249,000 will receive 7% pref. People who are going to invest between $250,000 and say $499,000 will receive an 8% pref. And if you're going to invest $500,000 or more, you're going to receive a 10% pref. So all in that common equity class A area, you can still slice it up differently. So just to let you know, you can get creative in that portion of it. So at Cash Flow Champs, we typically do a 70-30% split on the common equity, where 70% of the class A, well, 70% goes to the class A and 30% goes to the class B here, which is the GP. So in terms of priority for single tier equity structure, when the deal is sold, the senior debt gets paid first, then the class A common equity, and finally the class B common equity, which is a GP team. We get paid last in these structures. So a typical deal structure for our team at Cash Flow Champs is a 7% preferred return with a 70-30 split, like I said, where the first set of cash flow pays the 7% pref, right? So we protect our investors that way. They receive a preferred return. The first of the cash flow goes to the investors, and any cash flow above the 7% pref is split 70-30 between the LP and the GP respectively. If you have any questions, just put them in the chat box. I mean, I know we kind of go over a lot of information here, but I'm happy to entertain those questions as we go through or I'll pick them up at the end. So just let me make a clarification here, just that there's no confusion in that there's a difference between preferred equity and preferred return, right? Sometimes it get a little bit confusing, and so want to make sure we walk over with a good understanding of it. So the preferred equity, this is a financial instrument that provides supplemental financing that is subordinate to the senior loan, right? We spoke about that before. So the pref equity is a component of the capital stack. It's in this capital stack structure, right? The preferred return is not a part of the capital stack. The preferred return is a term that is used to determine preferential treatment given to the investors, because investors receive the first distribution of the cash flow from the deal, right? So they have preferential treatment on receiving the cash flow. So hopefully that clarifies it some. The preferred return is not a part of the capital stack. So Hopefully that helps there. I know it gets confusing sometimes. So the benefit of the preferred return is to protect the passive investor, right? I would suggest the passive investor should make this a requirement for the deal that they invest in, right? For it to have a preferred return, where as a passive investor, you get the first set of cash flow that's coming off the deal once your debt service is taken care of, right? You should be getting the first set of cash flow, because I believe the passive investors play an important role in making these syndication deals happen. And they should be protected. They should have some type of a downside protection, right? That's just what I believe, because without the passive investors, it'd be very difficult for a lot of syndicators to get deals done. So why not protect them with a preferred return so that they get the first set of cash flow? Let me touch on the dual tier equity structure for just a little bit. The dual tier equity structure is a little bit, sometimes you hear it call it dual tranche equity structure. It's just another capital stacks option for sponsors. And with the dual tier, by dual tier, we're primarily talking about 2 tiers of equity position for the investors. Before, we only had 1 tier of equity position, which was the common equity. Now we have 2 different tiers, which is the pref equity, and you also have the common equity, right? So Class A investors, which is the pref equity tier, they would not participate in the upside of the investment. And what this means is that Class A investors would not get any of the profits from the proceeds of a sale. The Class A investors typically will get a great return on investment, typically between 9 and 12% return on investment. So the reason there is no participation on the upside for the Class A investors is their preferred equity position. These investors are in a lower risk position, and since they're only subordinate to the senior debt. So once the senior debt gets paid, it will be that pref equity class. And so their protection is pretty strong right there. So your pref equity is typically about, say, between 20 and 35% of the total equity. So it's a smaller slice of the overall capital stack when compared to the common equity, right? So there are preferred return groups out there that can come in to these apartment syndication deals, and they can write a check for the whole pref equity portion. And these checks are normally sizable. Typically, these pref equity groups, they don't like to write checks that are smaller than $5 million or so. And so they can significantly help in terms of the capital raise that you have to do for raising these deals. For example, we have a deal right now that's live. It's in the Atlanta MSA, and it's a $32.3 million deal. And on that deal, we have about a $11 million raise, right? So if you have a pref equity group that can come in and write a $5 or $6 million check on that, then it only leave another $5 or so million for you to raise from common equity. One of the beautiful things about getting a pref equity group involved in your deal is that when the pref equity comes in and write a check like that, it tends to increase the returns that the common equity receives, right? So when you underwrite it, you'll see that your common equity is getting better returns. So not only are you reducing your raise as a sponsor, you're also giving better returns to your common equity. So that can be a powerful thing for you to utilize. The challenge is that you have to be doing bigger deals, because, like I said, they don't like to write checks that are smaller than $5 million. So I'm going to kind of leave it there in terms of our going over our structure here today. I hope that was helpful. Hope that was beneficial. I'm just going to look in the chat here just to see if I have any questions, and we can definitely entertain some of those. Maria's asking, do we offer a 7% preferred return? Yeah, we offer well, we talk about it. Yes, we do offer a 7% return. We also have a multi-class structure in the deal that we have going on right now in the Atlanta MSA. It's a 236 unit asset, and 231 of the units have already been renovated. So we're pretty much doing a managerial play there, and does have great returns on that deal. Is a 20% average annual return, 17% IRR right now, and we're cash flowing from day one. The way it's written right now, underwritten right now, and the way the numbers are looking, we're getting an 8% cash and cash return. But we do offer a 7% preferred return on that deal. We also offer a 8% preferred return, and we offer a 10% preferred return on that deal as well. So it just depends on how much you're investing will dictate what preferred return you get. But if you invest in it anywhere from 100 to 250K on that deal, you get a 7% preferred return. So yes, we do offer that. Another question from Mario said, do you adjust based on market conditions at purchase? I'm not sure if you're talking about, do we adjust our preferred return based on market conditions at purchase? Well, on our purchases, we normally underwrite our deals, right? I mean, we underwrite our deal prior to purchase, I'm sorry, I should say, right? And regardless of the market conditions, you know, we take into consideration the returns we're looking for, right? So if it's a good or bad market condition, it doesn't really matter, in the sense that if it doesn't meet our metrics, we don't buy that deal. But so right now we've been looking for months for a deal, just didn't meet our criteria, didn't meet the metrics we're looking for. But with this one that we found with the great returns on it, and the fact the work has already been done physically, and we only need to get in there and do a managerial play, and there is still a good loss to lease that we can burn off, we saw a great opportunity here. So we went ahead and we jump on that one. So you know, the market conditions has been changing over the months, but right now the deal that we have, I think, meets the criteria that we're looking for, and then we'll go ahead and we'll take that one down. Hope you can join us on that one. We'll be closing it next month. Spread the word about this webinar too, guys. We have these webinars every Thursday at 11 a.m. and we alternate between Prashant and myself, and we get you good content out there, and hopefully we can learn more about each other and do business together. So we'll just say thank you for attending today. Thank you, guys. Appreciate it. Spread the word about it. Come back next week. We've got a new exciting topic for you. Thank you.